Good afternoon, good morning, good evening, everyone. Not sure where you're tuning in from, but welcome to the Tower Wealth Advisory podcast series. We're here today with Dr. Jim Thorne. He's the Chief Market Strategist for Wellington-Altus Private Wealth. We've chatted with Jim once before on this program back in May of 2021. So he's our first returning guest. So Jim,
Ooh, Jim.
we want to thank you very much for joining us again. Normally he's got his time wrapped up on BNN, but he takes time out of the day to chat with us too. So thanks again for sitting down with us.
Thanks for having me, guys. Really appreciate you having me.
Yeah, you're welcome. Where do we find you here today, Jim? Are you back home or where are you at?
I'm in beautiful downtown Toronto.
Lucky
in
you.
A cloudy day, and really excited about the Raptors game against the Cleveland Cavaliers tonight. Hopefully the Raptors win.
Right on, go Raptors. Well, I got a couple of just housekeeping items to mention to our viewers. So Jim's going to be speaking today for probably about 45 minutes. We've got some slides that we're going to run through with him. There's going to be some polls popping out throughout the presentation. Feel free to answer those polls. We're just kind of gauging people's interest in what they're thinking. At the very end of the presentation, there will be room for questions, 10 to 15 minutes of time to pose your questions. You'll see a question tab down at the bottom of the Zoom invite here. Please feel free to post your questions. We'll then pose them to Jim. At the end, we'll be wrapping up and a questionnaire will go out just gauging your guys' constructive criticism, but that happens automatically when you end the Zoom call. So that's about all that I have to add. So we're going to turn it in the floor over to Jim and hear his market insights for the day.
Thanks, guys. So let's go back, say May. Let's go back and think about where we talked about it, and we've chopped a lot of wood since then, right? So let's go quickly back to, we call this the year of the Fed, and why do we call this the year of the Fed? Fair enough. So if we go back before the period of time of COVID, and the real concern had always been the growth was too slow and we could never reach our inflationary targets. And that was the big concern. The Federal Reserve in the summer of 2020 changed its policy goals to what's called average inflation targeting. And what they wanted to do was be able to allow the economy to run hot over an extended period of time. They wanted to be, shall we say, unshackled from the short-term goals of keeping inflation tight at 2%. They wanted to allow the economy to get some steam in terms of become overheated, get some growth and get some inflation. Because really, when you think about it, the only way we were going to grow out of this extreme amount of debt was to grow out of it. And grow out of it, it would, just like after post-World War II, it's going to take a couple of decades. So the one thing, remember, that we need to, about my point of view, is I take the period of time from, let's say, 1940 to 1960 as our reference point in history. And so my objective as a strategist is to try to separate the signal from the noise and to give context to teams and give context to investors. My real objective is to provoke thought. And I want to go far enough. You don't have to agree. You don't have to disagree, but I want you to be not to be apathetic about what I want to say. So my view is that when COVID hit, as we were talking in May, is that this was going to lead us into what's called the post-World War II reconstruction period. I got this by looking and reading Ben Bernanke and a lot of papers that were put out by strategists saying, how do we get out of this slow growth deflationary environment? It was to grow the economy like we did after World War II. And when COVID hit, and when we had the monetary and fiscal response done by the Bank of Canada, the Federal Reserve, and the ECB, the table was set for a long period of time of, shall we say, strong economic growth, okay? And also inflation, high inflation. In 1946, 1947, and 1948, after World War II, inflation was over 10% in the United States, and they could not raise interest rates. And at the same point in time, they controlled long-term inflationary expectations by communication. That's what's happening today. With regards to the Ukraine crisis, think about that as being exactly that the Korean War. People are thinking that this is the beginning of World War III. That's exactly what happened with the Korean War, hoarding. You had the Korean War, and you also had Russia shutting off Berlin. You had hoarding. You had huge spikes in commodities because they thought everybody was going to go on a war footing. It's kind of what we have right now that's going on in Ukraine. But we'll get to Ukraine in a bit. So that was the process. And so what we thought was going to be interesting and why we called this the year of the Fed is because the inflation that we're experiencing today was caused by a supply side shock, which was COVID-19. Let's be clear. Raising interest rates don't solve this problem. Okay? They don't. Period. The question is, would politicians, because it was a midterm election year in the United States, use inflation as a political issue? And if so, they would hold the sword of Damocles over the heads of the central bankers to raise interest rates, even though they know that they wouldn't solve the problem of supply chain issues because of COVID-19. So our issue was that when we open up the economy and we lap some economic data, and remember, inflation is year-on-year changes, and we lap some quarters of data where the economy was shut down and where you had deflation, our view was that the inflation was going to fall off rapidly, and the Federal Reserve and the Bank of Canada would not have to raise rates as much as people thought. And we still think that is the case. Okay? So let's pivot. Let's just hold that for a sec. Let's go through a couple of more slides, and then I'm going to dovetail Ukraine into the situation. So here are the shocks, right? COVID is a shock to the system. COVID, the slide, the picture on the left was Mount Tombra. That was the largest volcanic eruption in the early 1800s, which shocked the global economy to move from agriculture to industrial. Why? Because when that volcano hit, there was no summer. And in Western Europe, or Europe, had to live without any food. And that forced industrialization, that forced railways, that forced automobiles. It forced a new period of innovation upon us. COVID did the same thing. COVID accelerated the rate of digitization, right? COVID changed the way we work. COVID changed the way we do things. And the question for us is, we don't think we're going back. And so this all comes down to a book that I found. It's called The Fourth Turning. It's written by a couple of gentlemen named Strauss and Howe that says basically every 80 years, the economy, the global economy goes through an extreme structural change. This typically happens when we have the rise of populism. And that's go back to the American Revolution, the Civil War, the Great Depression, World War II. But it goes back further, and it goes back to a term that I use this as opposed to a fancy economic term called secular stagnation, where you get a period of time where you have extremely slow levels of growth, and you have deflation, and you have decline in standards of living. When you have declines of standard of living, people eventually get fed up and they want to have extreme change. That's where we are. So if you look at this demographically and through the historical lens and pull back 400 to 500 years, what we are experiencing today is akin to the US Civil War, the American Revolution, the French Revolution, so on and so forth. That's where we are. That's how profound it is. I want to go back to the demographics, because the way that Strauss and Howe talk about it is it's all driven by demographics. Well, in the 1980s, it was all about the baby boomers. And if you go back to 1945, coming out of World War II, what was so interesting is the baby boom. You had a 40% increase in population growth. And all you had to do, boom, bust, echo, in this book was follow what the baby boomers did. And in the 90s, what that did is it provided us a period of time between the late 80s and early 90s when the baby boomers were going through their family formation. You had strong economic growth and you had a huge bull market in equities. You had a new innovation. It was personal computers and the internet. Today is exactly the same thing. It's not the baby boomers, it's the millennials. The millennials are going through family formation. It's not the internet 1.0 or personal computers. It's Web 3.0. It's blockchain. It's artificial intelligence. It's autonomous driving. And that period of change has been accelerated because of COVID. So when I talk to older teams and older people, when I talk to baby boomers, I sit there and say, you've lived this before. Only here's the point. The millennials are driving the social norms, not the baby boomers. In the 1980s, baby boomers deferred or changed the way they invested compared to their parents. Their parents owned traditional brokerage accounts. It was the boomers that wanted mutual funds. Millennials now, they want ETFs and crypto. What my suggestion is don't fight it. It's just to accept it and to move on. But once we get past these concerns of this year and the Ukraine crisis and COVID, we're going to have a very strong period of growth to the end of the decade. The last bull cycle ended when the baby boomers' influence on society peaked. That was 2000. Between 2030 to 2032 is when the millennials' influence on society peaks. We say this time it's no different whatsoever. Going back and talking about digitization, if you like to read books, I would offer you two books, and I want you to read the book on the right first before you read the book on the left. When Apple went bankrupt in the 1990s, and it did go bankrupt, and Steve Jobs came back, he was kicked out of his firm. He read the book on the left by George Gilder called Life After Television, where it talked about Netflix. Didn't say it was the team company was going to be Netflix. When it talked about cell phones, when it talked about, the internet and what we are experiencing today, that was written about in the mid 1990s. And when Jobs came back to Apple, he gave that book to everybody and said, this is what Apple is going to be. It's now a $3 trillion company. The same company, the same individual, George Gilder, has written a new book, and it's called Life After Google, The Fall of Big Data and the Rise of the Blockchain Economy. That's where we are. Crypto is not about Bitcoin or Ethereum. It's about Web 3.0. It's about a new blockchain technology or a digital economy. Now, full stop. It's kind of interesting. I'm going to dovetail this in here, but the first internet that we had was developed to combat a nuclear war against Russia. And it was designed to be a backup communication system if Russia detonated a nuclear bomb in the United States and the telephone system went down. And they wanted to be able to hook up computers from universities so that there could be a backup communication system. The internet that you're using today was never designed to be the internet of the backbone of the digital economy. Blockchain is. So if you want to know where the future is going to go, you want a book to read, you want to have it to dovetail, that is the book. We are in, if I could take you back in Michael J. Fox DeLorean, we are back in the 1992 to 1993 era. We are about to go into an area of extreme disruption where Web 3.0 is about to be absorbed by the global economy. So when we started at the beginning of this year, we said that it's a typical midterm election year. And typically in a midterm election year, we have a 10 to 15% correction in the first 6 months. So we said, let's get defensive. Equity returns are always back-end loaded in midterm election years. We think that there's going to be 12% growth in earnings. We say growth is going to slow, inflation is going to come off, and we're going to have a very solid year in 2022. We still have a target of 5,300 on the S&P 500. We think that what is going to be very interesting now is that since the Federal Reserve cannot raise rates as much as people think, what's going to happen is interest rates is going to be totally counterintuitive. I get it. Interest rates have gone too far too fast. Interest rates are going to start to come down, and money is going to start to move into the technology area. It's starting as we speak. You have one of the most important pundits in the world, Dr. Larry Summers, writing about the fact that yield curves have inverted and we're going into a global recession. The Fed can't raise rates. We are on the path. This is exactly what we expected. It's happening quicker than we thought because of the war has caused the contraction in the market to happen sooner than we think. We think the lows of the market are in at 4,100. We might be range bound between 41 and 4,200 on the S&P to 4,600, but we go higher. We would also suggest that you think about, if you have big gains in commodities or inflation hedges, to start selling and moving into secular growth names, because by Labor Day, oil prices will be down and inflation will be down dramatically from where it is right now. One of the key tenets of our research is the fact that because ETFs are a driving factor in this market, you have to be proactive in selling and buying. There is no liquidity in the market because everybody uses ETFs today. New era for China. Will Mr. Xi become Mao? It is an important era for China. It's entering into it. And what I would like to say to you about this, to dovetail into Ukraine, is the country that's hurt most by high commodity prices is China. They need to get commodity prices down, and they will. And we think that China is a very, very interesting area to look at once we get through this year. Here's what we talked about before that people aren't focusing on. We mentioned that there was a generational pivot basically by the Federal Reserve in 2020. They want inflation to be hot. Will they be true to their policy shift? And to be clear, for them to change their policy, they have to get Senate approval. This is not a PowerPoint presentation. Not a PowerPoint presentation. This is very, very important. What I would say to you, the nuance I would present to you is this. They are still not, that's Leah Bernard and Jay Powell, their vice chair and chair. They need to be appointed. And they still haven't been voted on. And we think that once they get appointed and they don't have to deal with the politicians, that their communication strategy will turn decidedly dovish, where it is somewhat hawkish right now. So here's the reality, right? Let's look at the 2-year and let's see where it's going. This is a slide where it was taking a while back, but the 2-year, that red line is all the way up to 2%. And the 3% and the blue line is where they think they want it to go. And the green line is where Fed funds are right now. Our view is, with debt to GDP at 140 to 150%, there is no way they can raise rates as high as they want to. If they do raise rates as high as they want to, we will have a global financial crisis. We will have a recession. They know it. We know it. It's like, this is Clint Eastwood and Dirty Harry. Go ahead, make my day. Are they going to blink? We don't. We think they are, and it's going to happen between now and the end of the second quarter. Could they raise rates a couple of times? Yes, of course they can. Will they? Yes, of course they can. Will they raise rates 12 times this year? No. We are taking the under on the 12-time rate hike. We are taking the under on where that blue line, that terminal rate, has to come down. That's our call. And when they do that, the multiple of the price earnings multiple of the S&P 500 will expand from 18 to 22 times. And if that happens, you want to own secular growth names. This is the balance sheet of the Federal Reserve after World War II. Okay? Look at it. Look at that. It had two very small periods where they tried to contract the balance sheet, and then they never did. Okay? They tried in 1949. After 3 years of very high inflation, the economy went into a recession and we came back to deflation, came back. If they contract the balance sheet or tighten too much, that is what's happening. When you look at that, you say to yourself, the Fed can't contract its balance sheet. It didn't after World War II. It won't now. The attempt is that they will do it, but to me, there's no way they can do it without destroying the economy. Do they want to raise rates and contract the balance sheet in a midterm election year when there is war in Europe, when the economy is facing a recession? We say no. 5 year forward inflationary expectations. Why do we want to talk about something like this that's got such a weird title? It's because this is the markets talking about their long-term inflationary expectations of the US economy. Okay? This is when the Fed says, what are the long-term inflationary expectations? What are they? When Jay Powell sits there and gives a speech and says, our goal is to make sure long-term inflationary expectations are stable. Okay? It's at 2%. We're there already. So why are we talking about this? Why is this all this concern? Yeah, of course there's short-term inflation. Of course there's a spike. Right? Of course things are going crazy and oil's going up because of Ukraine and because of COVID. Yes, those are supply side shocks. But what the credit market is saying to us in that is that those inflationary expectations are going to come down dramatically and quickly, and that over the long haul, inflation is at 2%, our inflationary expectations. More importantly, the long-term inflationary expectations today is below where they were a decade ago. Look in 2010 or 2006, they're 2.5%. So why are we talking about this? Why isn't the Federal Reserve talking about this? Why isn't Wall Street talking about this? I don't know. All I do know is inflationary expectations are well anchored. They will not raise rates as much as everybody expects. So this is a little bit old, but this is the yield curve between the 10 and the 2s. I took this a couple of weeks ago. Do you see where the curve is hitting the black lines in 2000 and 2006? And it touched in 2018. It has now crossed the black line. When the 2-year yield on the 2-year is greater than the yield on the 10-year, the interest rate of the 2-year bond is higher than the interest rate on the 10-year bond. You have extreme tight credit conditions, and what comes next is a recession. We are there. What is the most profound thing is this. The yield curve inverted for the first time at the beginning of a tightening cycle. Going back to our period of time that we say the Fed cannot raise rates as much as people think, look at where this curve peaked at 1.5%. That is the lowest level that it's peaked at in the last 40 years. That's telling you that the inflation is well anchored. That's telling you that the credit market believes that growth once we get through this period is going to be low and that inflation is going to be low. And so we have been saying to them, or we have been suggesting, not to them, they don't listen to me, but the risk is on the other side of the mountain because of the excessive level of debt that's been added on. because of COVID, because of the rapid acceleration of technology, because of the demographics of the baby boomers getting older. Deflationary forces are stronger today than they ever have been in the last 50 years. That's why that curve peaked at such a low level. Are they going to grasp defeat from the jaws of victory, tighten too much, send the economy into a recession, and then have to deal with the aftermath where people will pivot and say, we are in a slow growth environment and interest rates are going to zero? That is the question. That is a $64,000 question that people and money managers need to ask. We suggest that they cannot raise rates as much. The charts and the credit market are telling you that. The pundits that go on TV are not listening to what the credit market is saying. This is Canada, okay? And what I wanted to do is if you look at the green line and the red line, I wanted to take the average consumer price index and I wanted to calculate. Remember I said the new target is average inflation, average. If you go back to 1995, and that's the beginning of this period that the central bankers chose. I didn't choose it, they chose it. This is the date that the Bank of Canada chose. This is the bank that the Federal Reserve chose. Jimmy had no choice. But if you calculate the average of inflation from there, it's at 1.6%. That is the red line. The green line is the 2% target. So even if we take into consideration where we are in the blue line, which is, yes, we know inflation is really high today. I understand that. Everybody's talking about that. That's on the front page news. I get that. But the risk to all of us is that the fact that even after that, we have had decades of deflation and nothing has changed. And if we tighten too quickly now, we go into a low growth deflationary environment in the United States and in Canada. And oh, by the way, our debt to GDP is 150%. Okay? Okay. So I want you to look at the green line. This comes from the Atlanta Fed. It's called the Atlanta Fed Wage Tracker. And what I want you to notice is that where all the wage growth is in that green line, not in the orange line, the blue line, or the purple line. Where is all the wage growth in the United States? It's in uneducated, service sector, non-white, with less than high school education that previously to COVID were living below the poverty level. So if we are going to have a central bank that is concerned about income inequality, where all the wage increase has really come from is in the area of the economy that was living below the poverty level. Every other sector and subsector, and I could spend hours on this data set and show you that, look, it's very concentrated, right? And if you say you're focused on the green economy and income inequality, then why would you raise rates right now when the only people getting the wages increases are those people that were living below the poverty level? So we think that cooler heads will prevail and that, we're going to get through this phase and they're not going to tighten too much. I want you to think about this. The market internals have changed. I want you to think about what the millennials buy and what the baby boomers sell. You see the line on the bottom, the curve on the bottom, that's active managers. That's people selling active managers, right? That's baby boomers. Baby boomers are the only cohort that significantly own actively managed mutual funds. Stop. The line on top, ETFs. Who buys ETFs or passive? Millennials. Do you see the change in the market dynamics? What is also interesting about what is the difference between an ETF and an active manager? If you went to Dave and you gave Dave $100,000 and said, I want you to buy me the ETF that tracks the TSX, right? Dave would enter the ticket in, and every stock in that index would be purchased, irrespective of price, irrespective of value, irrespective of anything. Price doesn't matter. If we gave Dave $100,000 and he bought an active manager, right? He may or she may not buy Canadian banks because of their view on interest rates, or he or she may not buy Canadian oil companies because she thinks that oil is going from 130 down to 85. So you're not going to have a blind just buy all or sell all, right? That affects the market dynamics. So when you sit there and look at what the market did over the last 5 days, that's everybody buying ETFs. When you look at the way the market fell off in March 2000, right? That's everybody selling ETFs. What's the lesson here? There is no liquidity. B, price is not, there is no price discovery. And C, you need to be proactive in terms of thinking about what you want to do, right? Yes, the old adage is buy low, sell high. I get it and repeat. Totally agree. You have to be earlier, right? You can't wait for it to be certain, because once it's certain, the trade has already happened, right? So look at the market right now. The market is already feeling and looking at the economic data saying the economy's slowing, interest rates are way too high, and inflation is coming off the boil. So before there's any proclamations, you can see the positioning happen as we speak. It's happening much earlier. You need to be much more proactive. That's the important, and that is just starting. Just starting. Okay. This is what do the millennials want, right? The social investing, income inequality, green economy, passive investments, crypto, family formation, but it speaks to a secular bull market, right? I think by the end of the decade, we could easily be looking at 15,000 on the S&P. It's not going to be a direct shot, but that's the way it's going to go. And just embrace it. For those of you that are old enough, I want you to go back and get onto YouTube, and I want you to go and Google Katie Couric's name and email with Bryant Gumbel. And I want you to watch a tape from 1994 when they sit there and go, what's an email? This is not going to grow, right? This is a scam, right? This isn't going to happen. Well, it's the same thing with crypto and blockchain. Now you've got the head of the largest money manager in the world controlling hundreds of trillions of dollars, basically saying the solution to our problems in the global financial world is blockchain, which is crypto. 10 years ago, he said they were saying it's a scam. We've seen this before. The younger generation hasn't. Older folks like us, we've seen it. If we went back to high school and took grade 10 chemistry over and over and over again, eventually we'd get a good grade. It's no different. For those of us that are old, this is what we've done. You've seen this before. The characters have changed. The names have changed. It's the same thing. So we know Mark Carney, good Edmonton boy. He's a goalkeeper, right? So we can't hold that against him. He's the driving force behind green. Given the events of what's happening in Ukraine, green is not going to go away. Still going to be there. Central bank digital currencies. The Bank of Canada is working with MIT right now for central bank digital currencies. The knock-on effect, the important thing in the finance space that nobody is talking about, that happened in the Ukraine crisis, was the sanctioning of the central bank of Russia. That is like the equivalent of dropping a tactical nuclear weapon on the financial industry. Okay? This means that the Americans are willing to give up their position as sole reserve currency of the global economy. And think about, just Google it when you go leave. Think about what's been said. Powell in front of the Senate said, we are okay with a competing global reserve currency. China and Saudi Arabia said they might start trading oil in renminbi, RMB. Russia is talking about accepting only rubles. The Americans are talking about sanctioning gold, going after all US transactions in the dollar. This is a monumental, generational pivot of historical proportions that I cannot amplify enough when we are talking today. Okay? You need to keep an open mind, have a high degree of humility, but recognize the fact that how much of a new era we are in, and the Ukraine crisis and the response on financial, it wasn't the sanctions of Russia with SWIFT, the SWIFT payment system. Iran has been sanctioned before. Venezuela has been sanctioned on the SWIFT before. It's them kicking the Russian central bank out. That is profound. They basically said, anybody that has US dollars, they're not good. We don't care. We're walking away. This is the biggest event in financial markets since Bretton Woods in 1945. We've talked about this. Given all that, we still have a wonderful run until the mid portion of the next decade. Going to be lots of bumps and bruises, but they're only bumps and bruises. And given this new environment, just recognize the fact that stocks outperform bonds most of the time, and that 70 to 75% of the time, stocks go up, right? As we talked to you before, we think mega cap stocks are mega tech, place to be. Okay? That's where we would go. That's where the money's going. You can see it happening today. That's every day, more money starts to flow in. Well, MSM talks about energy, uranium, commodities, and inflation. To be clear, I want to say this and I want to emphatically bang the table on this. I still am a proponent of the commodity super cycle. I just think you're going to get a better entry point later on in the year, right? I think you want to own a significant portion in your portfolio. I think oil is fine. I just think oil, we're going to get an Iran deal. You're going to get the Venezuela deal. We're going to get a Marshall Plan for energy. I bet you we build the pipe. We're going to build the pipeline, the Keystone Pipeline. The head of the EU today, pardon me, just came out and said that they're going to cut a deal with Canada to ship oil and accept oil from Alberta. That's bullish for you guys. How are we going to get that done if Trudeau has signed off? I got one thing for you. Pipeline to the East Coast. This changes everything. Pipeline to the Pacific, pipeline to the Atlantic, pipeline, more pipelines to the United States. Lastly, and I know I'm talking to smart energy people, but let's go back to the brick trade back 2 decades ago. So can we stop expecting the mega cap majors in energy to lead the CapEx cycle? When the brick trade happened in 2003, they were the last to the dance. Who goes first? The small cap, the micro cap, and the mid cap, right? When you start seeing action like that, we know where we are in the cycle. It has yet to begin, okay? Early stages, but with everything in this business, Trees don't grow to the sky, right? So if you're thinking about adding to your energy, I would wait for a couple of months and wait for the ceasefire in Ukraine, and wait for the Iran deal and the Venezuela deal. Everybody makes a boatload of money at $75 to $80. If you just would have invested in Amazon in 1997 and you put $10,000 into it, and you just would have closed your eyes and you would have ignored all the hyperbole and sell this and buy that and just held on to it for 10 and just rode the cycle, right? You'd be worth $25 million US right now. Look at the volatility, look what's happening. Same thing's going to happen with technology going forward, right? There's ups, there's down, there's pullbacks. Amazon lost 70% of its value one time. It's lost 50% of its value 7 times as well. But if you just would have held on to it, you would have taken 10 grand and parlayed that into $25 million. The big question I have for myself, because I'm talking to myself right now, is why the heck didn't I do that? Well, this time it's not different. Find those technology stocks that you like, that you're willing to hold for a cycle. We're just repeating the same cycle over and over again. This is the inflation and bottlenecks I want to reiterate with you, okay? Do you see the blue line? The blue line is the Cass Freight Index. It has fallen off substantially. Do you see the red line? That is the year-over-year change in CPI. Red follows blue. The blue line is now negative. Typically, red follows blue by 6 months. I think we know where inflation's going to be in 6 months. Okay? You're forewarned. Okay? This is tried and true. Lots of smart money people use this as their guidepost. So I want to say a couple of things about what's going on, right? This is a midterm cycle. Yes, it's playing out exactly the way we thought. Okay? What we didn't know in a literal sense is we didn't know about the war in Ukraine. And it's devastating what's happening on the ground there. To be clear, a couple of footnotes. In the last decade, it was found out in Ukraine that there is as much oil and gas in Ukraine as Russia has. So there's massive energy reserves, shale oil, and deep water oil. If you want to know where the oil is, next time you watch CNN and they put up the map where Russia is, all those red spots on the map, that's where the oil and natural gas is. Okay? So that's one. Two, and you guys know this more than anything else, Russia has to sell the oil and natural gas. Think about the oil in Alberta. If you shut the pipeline down and the trains down to the United States, where does the oil go? Assuming we don't have pipelines elsewhere, right? It just sits there. The oil that they are shipping to the from Russia to Europe can't go anywhere else. They have to sell it. They need to sell it. Okay? So if they can't sell it to anywhere else, if it's going to take them 3 years to build a new pipeline or 2 years to build a new pipeline, and God knows they just finished the Nord Stream 2, which cost, I think, 12 billion US, and it took 4 years to build. That pipeline is from Russia to Europe. That pipeline isn't going from to Russia to India, from Russia to China. There's already pipelines there, but they can't take more capacity. They're maxed out. There will be a solution. Okay? It's not going to be a great solution, but there will be a solution, and oil will flow because Europe needs it and Russia needs it. the key point you have to look at is the sanctions that they put on and what they did with the Russian central bank and how that changes things going forward. And what do we do? Well, just think about this. Justin Trudeau just had an agreement with the EU or talking about shipping oil to Europe. Looks like our prime minister might be open-minded to building pipelines, right? Looks like we're going to have a CapEx phase because energy is a matter of national security, right? That's hugely positive. Let's look at the other things. Germany is going to become an offensive military power. Europe is going to spend significant amount of money on military. That is positive for economic growth. You need to increase bonds, selling of bonds for the government for that. To do that, you need low interest rates. Pardon me, another reason why we cannot raise interest rates. I would not be surprised if Japan militarizes. So you need to think about having some military exposure in your portfolio. A company like Lockheed Martin, Raytheon, right? Once we get through this, we're going to have a period of really nice, solid growth. And in that environment, the Federal Reserve and the Bank of Canada can normalize their rates at a much more normal, patient rate, like we did after World War II. Things look very good. I'm very bullish on the market. We just need to get through these next few months. But I am constructive going forward to the end of this year and out to the end of the decade. I think that's about it, guys.
Well, Jim, that was insightful as usual. I'm always excited to hear you speak, and I always enjoy reading your emails every morning. I know Dave reads them as well. I have to think that sometimes you must do nothing but consume and read for hours on end each day, because those emails are great summaries that we get. It takes about 10, 15 minutes for us to read them, but I can't imagine the amount of time it must take you to put them together.
Well, thanks. I mean, I got to do something because I can't watch the Leafs anymore. They drive me up the wall. Right? But no, this is what I do. This is what I love. And so I find when you're for me, when you see everything that we talk about, I think it was Lenin that said, there are decades that come along where nothing happens. And then there's weeks where decades happen. And the change in our history and the structural changes that we're going through, we are living through a period of time that they're going to talk about for hundreds of years. That's how wild this is. And so that's why you get excited and I just enjoy it.
That's great. We've got the floor open, I believe, for questions. So if any come in, we'll certainly put them in front of you, Jim. I did have one, if we can backtrack in your...
Just let everybody know, just the question and answer button on the bottom. If you want to ask a question, just click on that, type in your question, and we'll ask Jim that question. So
yeah, just one quick question to get the ball rolling. You talked a bit about the pundits not listening to the credit market. And earlier you mentioned that we're trying to control inflation perhaps with messaging. So are they not listening to the credit market on purpose and using messaging as a way to help curb inflation a bit? Is that kind of what you were getting to there? Or
yes, they're using, when you really think about what the Fed can do, the Fed can really not, they lag everything. They lag the credit markets. And really the only thing that they can do is control expectations through their communication, right? And so I guess what I can say, and I want to use another hockey analogy, I've been at this game for a long time now. And people, why do you still do it? And I sit there and I say, because the game is slowing down for me now. Do you know what I mean? Like I can see the ice and it's slowing, just like Gretzky when he was playing. The game slowed. The game slowed down for him for a very young age, right? So when I sit there and you see and you do enough reading and you've been through enough cycles, a lot of it's common sense, and you've got to understand that. If you understand the backstory, you also understand the fact that they can't raise rates. Right? So if they can't raise rates, but they're rightly concerned about long-term inflationary expectations breaking loose, which is a fair, noble concern. No one's arguing that they shouldn't. The only way they can do it is they have to sound tough. The risk they have is go back to the playground, right? The analogy. Eventually, the bully talking, or in the hockey, right? I mean, Dave Semenko for the Oilers, he didn't talk, right? He dropped his gloves, right? Eventually, the Fed has to basically change and pivot their tone, or no one's going to listen to them anymore, right? That's what they're doing right now. They have to pivot. So yes, everything's anchored. They've done a fantastic job, both the Bank of Canada and the Fed. And now they have to wait for the data so that they can pivot and change their story. We think that happens between now and the July 4th.
That's great. I think our video's gone a little snaky here. We're frozen, but our audio is still good. So we'll roll with the next question. When you're talking about inversion of the yield curve, and potentially if they overcook it on raising interest rates, what's the average timeline or time frame between inversion and recession?
So, great question. First off, it's a really profound question, and secondly, I hate saying "great question" to a good question. So that let me just frame that. Look, I know it's. So here's what the data says, right? So in some senses, we're just doing probabilities, right? Typically, the market keeps going up 16 to 18 months after the inversion that we're experiencing now. Okay, so we have 16 to 18 months. Okay, that's one. And typically what happens when the economy slows, capital flows into the areas that have secular growth. That's technology. And those areas that are that have, shall we say, have a strong secular theme behind it. That would be commodities, right? In 12 months after the inversion, going back to 1945, the average rate of return is 16%, right? So what happens is it gets we keep going, and the economy and we climb the wall of worry. I'm going to use this fancy term. The breadth in the market gets narrower and narrower, and it goes into technology names, and those what I call those it names, where people think there's this unique situation brewing where growth in that industry or sector will happen irrespective of how strong GDP growth is, right? So I think commodities are going to be strong, and I think technology is going to be strong. And so I think what you do is you need to play one off the other. And so we've got a long way to go. But every recession from 1945 has happened 16 to 18 months after the 2s and 10s have inverted. Every one. It's been 100% hit rate.
All right, we'll mark our calendars. Questions popping up?
Nothing popping up, so we'll fire away on our questions.
You go ahead.
Maybe Jim's answered them all. You mentioned, and this is interesting. I mean, obviously, we've been in the business for quite some time, Tyler and I, and we're typically pretty active in our management, and we also have chosen to use active managers. We're not ever professing to be great stock pickers. We'd rather pick the best managers who are the best pickers. So when you see the massive inflow over the periods of time into passive investments and the decline in active, to me, it just means people are, they're just willing to put their money down on whatever ETF makes them feel good at the time, or where they feel they're going to make the most amount of money. I would assume, does this mean a good active manager can take advantage of the just pure money being plopped into ETFs and to position, or are they kind of locked in that, there's a change in price that's going to blast their actively managed fund for no reason other than the flow of money?
There will be good active managers that can take advantage of the golf course that we're playing. Yes. And our objective is to find those good managers, right? But you're absolutely right when you talk about the fact that because everybody's using these ETFs, there's this term that I have friends. I lived in DC for 20 years, and there's a term these strategists use. Like they say, we live in a post-factual world, right? The facts don't matter, and when you buy an ETF, facts and like the valuation doesn't matter. Nothing matters. It's pure momentum, right? And so. And it's dumb money in the sense that, but that's okay, right? So when I talk about this, I just sit there and go, the mistakes I've made in this business, in this industry, is not the logic side. It's when I'm thinking we're playing checkers and we're playing chess, when the game is different from what I think it is. And so when I talk about passive versus active, all I'm really saying is be cognizant of the game we're playing. That you might look at a stock and going, what the heck is going on with this stock? It shouldn't be going down. It's got great fundamentals. It had a great quarter. And you sit there and go, yeah, well, it's the number 3 holding of this ETF, and the ETF's being sold and bombed, right? And so as long as you understand that and say, well, I'm going to take advantage of that and buy it because it's got a good long-term track record and everything's going to be fine. That's what's happening. You cannot take into consideration there's no information in the day-to-day moves anymore. None whatsoever. Price does not provide any information in terms of the fundamentals of the market.
Well, it kind of sums up in the sense of what we work from. I mean, our goal has always been, can we use active managers, get the same overall rate of return with less volatility? That's kind of the name of the game. And I couldn't imagine trying to put a bunch of passive ETFs in the types of portfolios we run and lower our risk. I mean, it just goes up, and that's the problem. And, you're getting some ETFs that are, they're venturing into areas that are thinly traded. And if you get any movement, you as a active manager that hold any of those types of securities, your fund plunges because the ETF just gets brutalized with no logic.
You're absolutely right. And that's so my job isn't to say it's right or wrong. My job is to say be cognizant of the game or the golf course you're playing on right now. And if you can find somebody that can take advantage of that, then that's great. That's what you're supposed to do, right? I mean, it's just the game is completely changed. And it's the way you explained it is absolutely right. And so that's what you have to do. And if you find somebody that can do that, but what this does though, it forces those active managers that aren't active managers, that used to be benchmark huggers, that would charge you 2% management fee. It chases those guys out of the business, right? And then what it also does is it amplifies the momentum within the market, because when you turn on when I turn on and watch a basketball game, or, there are commercials where people feel that they can outperform using ETFs without for financial advice, right? I mean, this is a tough game that we play. It is very, very hard. We are going to be wrong 30 to 40% of the time. And when we're wrong 30 to 40% of the time, we are superstars, right? And so we have a big cohort of people that think that they can do it through ETFs and do it by themselves. Well, if they do that, then they are buying high and they're selling low. But that's exactly what they want. I mean, if it's a zero-sum game, right? If we're playing a game of poker, right? There's an old adage, as long as the more suckers that are at the table, the more money we can make. And so we don't want to change anything. We just want to accept the fact that there are a lot of people that play the game that way, and let's take advantage of it. Let's just take advantage of it.
For sure. We're over by a minute, but I kind of have one last question. I think if you got a second,
Sure.
If we can stick this to you, I think it's pretty relevant to what you said. And there was it was about digital currencies, and that central banks are all contemplating to get in the game. Where does this all kind of fit together between, say, I would call Bitcoin probably one that would survive, but you go Bitcoin, US dollar, and central bank digital currencies. How do these all work together then? And what's going to come out of this?
Okay, so let's quick accounting lesson, right? Okay, so or in money lesson, central bank lesson. Banks don't create money. Central banks don't create money. Money-centered banks create money. and they create money through ledger transactions. They create a debit and a credit, right? Money isn't created on a printing press and shipped out on skids, okay? So, and it's a ledger technology, right? Well, what blockchain is it's a distributive ledger technology. So it's digital, but it's a ledger technology, just the same as the technology that we use right now to create money and to buy and sell money and to sell in loans. So where people get lost in all of this is they think of Bitcoin as a coin and Ethereum as a coin. They are software, internet technologies that act like an accounting ledger. Okay? That's it. 2, the difference between Ethereum and Bitcoin basically is you can do a ledger transaction with Ethereum and you can put comments in that transaction. Like you're doing an Excel spreadsheet and you click on, you can have comments that says, guys, I took that bet that you sat there and said, if the Maple Leafs win one round of the playoffs, I get a Wayne Gretzky signed jersey, right? And we sign it. It's on the ledger. Everybody sees it. And when that happens, that transaction takes place. That's all blockchain is. It's transparent. What Ethereum and Bitcoin you can do, which is different than the internet that we are talking on right now, which is HTTP, right? That's the internet protocol. If I just want to buy a portion of the protocol and get and benefit from more and more people using the protocol, we couldn't in the 1990s. We had to buy the application on top of the protocol. We had to guess on whether it was Amazon or stick.com or Ask Jeeves. Here with Web 3.0, we can sit there and go, okay, we think there's going to be a payment rail that's going to be perfect for payments. That's Bitcoin. And then we think there's going to be a smart contract, okay, rail or platform, and that's Ethereum. Hey, I think I'm never going to use these platforms, but I'm going to own these platforms. Just like I'm going to buy a piece of property in Muskoka, I'm not going to develop it. I'm just going to I think the property is going to be developed and the property value is going to go up because people are going to, build more cottages or people are going to use the portfolio or the internet more. When you talk to the hardcore crypto people, that's why they are buying this. We need to build a new internet. And maybe there are 3 or 4 different platforms. Maybe there are, hear me out, 3 or 4, not 500, not 1,000, not a gazillion. Okay? So that's the core premise of it. But let me go step. Where does it go from there? And I'm just going to let esoteric. If you got me a Wayne Gretzky rookie card, right? And we wanted to trade that and we digitized that, the ownership of it. Then we could transfer, and it was put on the blockchain. We could transfer that ownership from Dave to Jim, and it would cost us nothing. We wouldn't have to hire lawyers. Or if you sold your house, you wouldn't have to prove that you owned it. You wouldn't have to have the title, okay? With blockchain, and this is Larry Fink talked about this today in his letter to CEOs. El Salvador made Bitcoin legal currency. Why do you care? Because 30% of their GDP is what are called remittances. 30% of their GDP are El Salvadorian citizens working in the United States and sending money home. Okay? The average ticket size is $125. Western Union charges $30 a transaction. Okay? If that El Salvadorian took their money and opened up a Coinbase wallet, right? And they took that $130 and bought a little portion of Bitcoin and sent it to their mom's wallet in El Salvador. Do you know what the cost is? 0. That's why the banks have to evolve, because they took the technology of the internet and the computer and made financial weapons of mass destruction, as Warren Buffett would say, with derivatives, as opposed to cutting out costs in the payment system. When Larry Fink, head of BlackRock, talks about this is where we're going, we all need to take a back seat and going, this is going mainstream. This is legit. How am I going to participate in this? And do I want to buy a little bit of property in my portfolio to participate in the growth of this new technology that is going to reduce income equality around the world? That is the question. And if you think about it that way, that's how I think about it. Then I go, aha, okay, I get it. If you think it's a coin, right, and you're whipping it around, I mean, there's no value in the coin, right? It's a scam. I get it, right? But if you think about it in terms of internet protocols and cutting costs out of transactions cross-border around the world, or a cut cost in terms of contracts, think about where this goes, though. These things called non-fungible tokens. Let's say we could get back into the late 1970s, okay? Take our Michael J. Fox's back. And let's say when Gretzky joined the Oilers, right? we could do a non-fungible token, right? And what we could do is get ownership on his future cash flow as a hockey star, okay? And we could get a portion of that. And Wayne could sell that out. And so that you and I could sit there, is Gretzky the guy, or is it Bruce Boudreau or whatever? And all of a sudden you can start trading these things. You're making bets, right? You're making bets on the future of a hockey star, right? You're making bets on the future cash flow of an entity, right? So it's a security. It trades on an SEC approved platform. That's what non-fungible tokens are. Now, last thing, people say this is weird, and then I go back to the late 1990s. Last thing, David Bowie, the rock star, in the late 1990s took his record or his music library, and he basically issued a bond and said the interest payment on the bond will be equivalent to the cash flow that my music makes being played on radio, being played on TV. It's been done before. It's just a different form factor, and it's been digitized. Every asset, every farm, your house, professional athletes, think about music, is going to be digitized and traded on these SEC approved exchanges. Now, how long does that take? I don't know, right? But we're in the early days where, in the non-fungible tokens, where you've got people paying 50 grand for some weird art that looks like my niece did it, right? That's scam. But we had scams like that in the 1990s with stick.com and dog.com, right? So it's no different than any new technology. But it is when you have Larry Fink, when you have the Bank of Canada working with MIT, when you have El Salvador, this has gotten past the point of this is a scam. This is going mainstream. This is going mainstream fast. And when it does, you have to make a determination that is this okay for you? It might not be. And that's okay, right? You don't have to. It's a free country. But don't say it's a scam. It's going to be, we're digitizing everything, and we're going to be using it with a new internet protocol.
Nice.
Well, back up the truck. Let's start buying.
We should talk to you the next time about this one, just alone by this one, yeah.
Well, Jim, we've went over time, so we appreciate you sharing your thoughts and your extra time with us. And And we look forward to getting you on this podcast again. We always appreciate your insights.
Cheers, guys. Thanks for having me.